Hello, everyone. Hello, world. Welcome back to Cryptochain with Sim. My name is Cryptochain. My name is Sim. So, as always, we're here at beautiful Tropical Nomad in partnership with our friends at Digital Nomad Indonesia, just bringing you a podcast explaining in simple English terms what this whole crypto space means, how to understand it, how to really be able to participate in it without having to think that it's so complicated that it's beyond your level of understanding. I speak English. I do my best to speak in very simple terms. Sometimes I do simplify things for those who actually know the space really well. They may think that I'm simplifying a little too much or using analogies, but that's my point. That what's the point of making it so complicated that the average person doesn't understand it? Don't we want the average person to? And you're not average, you're amazing. But our friends and family, we want everybody to be able to understand it. So my goal here is to make sure we bring this down to earth and help you really absorb it. So we've been on a journey together. We've been kind of going through, the investment journey. So this is now the third part of that. We've talked about the fourth part, actually. So now we've talked about basically just a macroeconomic overview of what's going on in the world, why crypto fits in there, why it's important. Then we've looked at the different kind of pieces of crypto or different sectors of crypto, and also individual cryptos and what they do. So you can really understand, like, what does blockchain do? What does Bitcoin do? What does Ethereum do? And all that, right? So hopefully we've simplified that. If you haven't seen that stuff, please find it on YouTube under Cryptochain with Sim. You can also find it on my website, which is excellenceconsulting.co. We didn't put the M on there. It's just .co because we're cool. I know. Thank you. Okay, so today, we've already gone through talking about the cryptos, and we've also actually talked about entering the crypto market. So now we're going to be talking about what it's like to be in the crypto market. So this is assuming that you've understood it, you've learned about it, you've entered it. What do you do when you're there? What does it mean to stay in the crypto market? So generally speaking, there's many different ways of staying in this market, or even choosing what you'd like to do in this market. And just another little overview of kind of why it's important to have this is because in order for you to succeed in this market, you have to have a good strategy as to what you're doing. You have to know it ahead of time and really plan in a way so that you maximize your likelihood of actually making some money in this market rather than losing money in this market. Now, remember that disclaimer I always give. I'm not a financial advisor. It's not tax advice, legal advice. This is just for informational purposes only. This is my opinion. Please don't just make decisions just from what you hear here. Hopefully I can inspire you to go do some research, but I am not a financial advisor. I'm a good advisor. Like, my friends come to me for advice, but I'm not a financial one. I'm not registered. Okay, so what does it mean to stay in the crypto market? So let's even think about, what are you doing there? What is it that you're actually doing in the crypto market? There's many different ways of staying in the crypto market. So the traditional way of kind of thinking about it that most people think about, and the route that most new people take, is you're going to invest, right? So you're effectively going to put some money in, you're going to put it into some coin. So there's kind of two ways of even thinking about your strategy for that. So there would be one type of investing, which is long-term investing. So corporations and some of the biggest players in this game would invest in this way, where what they're trying to do is accumulate assets. What that means is they're investing money today, but they have strategies that are 2, 5, 10, 50, 100 years long. So effectively, they're investing for 5 years, for 10 years, right? And their goal is to purchase assets and hold them. And you've probably heard the term hodling. If you haven't, as soon as you enter this sphere, you will start people being like, do you hodl? I hodl. It just means holding on for dear life, HODL, hodling. But actually, it just means holding, just holding on to it. So that kind of long-term investment strategy is that you're going to enter, you're going to buy assets which you have faith and belief that they're going to be there for 5 years or 10 years or however long your strategy is, and you just hold them, right? Now, as we've talked about before, but I'll kind of reiterate, this market is very cyclical. So because this market goes through these very defined cycles where the Bitcoin halving happens, that causes the supply of Bitcoin to drop, which causes the price of Bitcoin to spike, which causes the price of the rest of the coins to spike. I mean, there's no direct correlation per se. I mean, there's correlation, but there's no reason why the rest of the coins spike. It's just human psychology that makes it spike. But the point is, the halving happens, the price spikes, then it drops off, then the next halving happens, the price spikes. So a long-term holder, or a hodler as we call them in this sphere, because we're cool, they would not sell through all of that. So you would put your money in and you just hold on to it. When it goes up, you don't sell. When it goes down, you don't sell. Obviously, once it comes down, you would buy more. That's one way of doing it. Now, I'm not saying everybody who's new who enters does that. I'm just saying that's one way of getting in there. Now, everybody who's new who enters usually plays the other strategy of investing, which is investing when the prices are low, and then waiting for the prices to be high because there's that spike in prices, and then they sell it, right? And then they wait for the prices drop back down, and then they buy more at the bottom, and then they wait for the next pump, which will happen in 4 years, and then they sell it. So that's the investing strategy basically. So if you're thinking about things on a 5-10 year scale, buying things today at whichever price you get it is great, because in 5 years the market will be much farther along compared to where it is today. In 10 years the market will be completely indistinguishable from where it is today. So prices will be way higher than they are today. So that strategy does work on the really long-term scale. The buy low, sell high strategy works really well when you enter the market early. So let's say this year, last year, even the year before that, so 2019, 2020, even the beginning parts of 2021, when the prices are low, you purchase, and potentially when the prices are high around the end of 2021, they're projected to be around the end of 2021, but nobody really knows for sure. When the prices are high, you would sell and you'd make a profit at that point. Now, there's some differences in those two strategies, in that if you go with the first one where you just buy it and hold it, you don't get any tax, because buying cryptos has no tax. Selling crypto has a tax. So anytime you purchase crypto, you're effectively investing, so there is no taxable event. But as soon as you convert from one crypto to another, or you try to spend it, or you try to sell it and turn your money back into cash, that is a taxable event. So somebody who's just holding it for 10 years, they're not going to pay any tax on it. That's a fantastic way of being able to invest and not have to worry about any tax, and just completely keep growing your assets. And obviously one day when you do sell, there would be some tax. The second strategy of buying low and selling high does come with some tax. It's a taxable event, because you are buying it at the bottom. You are growing your assets, and say you put in $1,000, it turns into $5,000. Now you've made $4,000 of profit, so you would need to pay some capital gains tax to your government. So there's some differences there. Now, some people do kind of a combination of those two things, where you are buying it low, selling it high, and then when the market crashes back down and prices become cheap again, then you buy it at the bottom with the kind of profits that you've made. And doing that a few cycles over is a great way of multiplying your wealth, and also being able to have a longer term strategy where you're not just here for the 6 months. You can make money in the 6 to 9 months. Again, I don't know if you're going to make money. You could lose money. Not financial advice, but you could potentially make some money during that time. I know I say that too much. This is not financial advice, guys. Not at all, but you can make money in the 6 to 9 month range, and then on the longer term, on the 4 or 5, 10 year scale, you're still making a decent return on your investment. So those are kind of two ways of investing, and that's what we call investing, which is put your money in for some period of time, and then over time grow your assets. Now, there are other ways of being in this market. I know most people think that that's the only way to do it, but there's many, many other ways. I'm just going to talk about a few of them. So another kind of new thing that's developed is something called yield farming. If anybody says yield farming to you, all they're saying is paying you interest. That's all that is. You're familiar with that. You put your money somewhere. Usually you'll put your money into a bank. The bank will lend out your money to other people, and then you get a small interest rate for giving them that money, lending them that money basically, which they lend forward. Obviously in a bank they'll pay you a 0 point something % rate these days, so effectively it's almost useless to do that in a savings account. In the crypto sphere, there's some good return rates. You can get 5, 10, 15, sometimes much higher than that percentage returns. Some of the coins are even giving 100% returns. Obviously then you're taking on a much higher level of risk, but the point is you can give your assets to a platform to lend. They'll lend it to other people, and they'll give you a percentage back for allowing allowing them to be able to borrow your money. So that's a good way of making consistent returns and reliable returns. It does come with some risks, obviously, because you are handing over your assets to another platform. They could get hacked. Their tokens could have issues. There could be a plethora of things that could happen. So you are taking on some risk, but that's one way of doing it, where instead of investing, you give your money over to a platform and they lend it and they give you an interest rate. That's called yield farming. Great. Another way of doing it is something called staking. If you hear the word staking, all it means is you are locking your money in a digital wallet, and you locking that money allows you to participate in the network. Now, if you watch some of the previous podcasts, you will have learned that all of these cryptos are basically groups of computers that are running, the networks of computers that are running, and those computers do work. Right? If you lock some of your money in a wallet, then you become one of the computers that's doing work. That's basically what staking is. And now if you're doing some of the work, you will get the fees for whoever needs to have that work done. They pay a fee to have that work done, and you'll receive some of those fees for participating in the network. So effectively, you're doing the work, you're using your money to do the work, and you're earning some of the cryptocurrency that you're staking on. So that's staking in a simple term. Another kind of thing that's becoming much more popular is actually trading cryptocurrencies. So whenever you hear trading, somebody's a trader, there's a few different kind of sections or a few different ways of trading that can happen. So some cryptocurrency traders will do something called day trading or swing trading, or margin trading. So what margin trading is basically you can take your money and you're making bets on the price of crypto going up and down. You're not actually buying any crypto. You are actually making bets that the price will go up or it'll go down. So when you hear, like, you've probably seen the movie Big Short, or somebody say I'm longing the market or I'm shorting the market. If you've gone through this GameStop fiasco and everything that happened with Robin Hood, you're probably familiar with, like, there was something going on about shorts and longs. That's precisely what trading is, where you're making bets and you're saying the price will go up or the price will go down. What margin trading does, though, is you are allowed to effectively borrow some multiple of what you're investing in order to be able to play with it. So it's almost like I have $1 and I make a bet and I say, I'll bet $1 that the price of Bitcoin goes up. But I go to somebody else and I say, hey, I bet $1, and if you let me borrow $9, if I lose, I'll lose my $1. But if I win, I get to play with your $9. Now, it's not like they give you the $9. They just let you play with it. So I know it's going to get a little confusing, but that's a simple way of doing it, where you can multiply how much you have to make a bet. So if you lose what you have. But if you win as if you won the bet with the amount of money that you've borrowed. And there's a small interest rate on it, but over the long term, it's actually something that's very profitable. And a lot of people don't know this, that, like, and I've talked about this before. Please watch the overview podcast to get the details. But the most amount of money in the world is not in real estate. It's not even in money. It's not in stocks. It's not in bonds. It's not in gold. It's not in commodities. All of those things combined, so stocks, bonds, gold, real estate, all the money in the world combined, has less money inside of it than something called derivatives, where they're just making bets. These bets that we just talked about, there's more money sitting inside of those bets than there is in the rest of the world combined. I mean, that's insane. But the idea is that is what trading is. That's what margin trading is. That's one thing that I do myself, because it's a great way of learning a skill that's able to generate an income. It's a great way of being able to make money when the markets are going down, because if you're investing, it's great when the market's going up, but once the prices start to go down, you have no way of technically making money. Traders, though, they're shorting. They're making bets saying, I bet the price will go down. And they're making money all the way down the market. How it works, honestly, it gets a little complicated, but the point is this exists, and that's something you can do in the markets as well. Obviously, when you're doing that, my biggest recommendation is please don't just go in there and start doing it. Now that you've heard it from here, and you'll probably see people on YouTube just making all this money doing it, it's not as simple as it seems, because you have to understand that you're risking your money. You're making bets at that point, right? So when you're investing in safe assets. What that means is you buy an asset, and until you sell it, you won't lose your money. Yeah, the price might go up and you're making money, but the price might go down below what you bought it, the point that you bought it. But as long as you don't sell it, you're still holding that asset, right? Later on, when the price goes up beyond where you are today, you could sell it and you still make profit, but you never lost your money per se. Whereas in trading, you're making a bet. And what that bet means is you're betting the price goes up. And if the price goes down, you lose that bet. It's kind of like a casino. So you are gambling with your money effectively, in a way. It's a little bit different from gambling, but you can simplify it down to those terms. So if you're going to do it, make sure you learn how to manage your risk. Very important. Most people think that it's just getting in, making these bets, picking the right bets to put money on. You just willy-nilly throw money at it, and over time you'll make money. That's completely the wrong way to do it. That's why most people lose money in that game. It's only the professional traders who are going to actually win out, and they have strategy, and they make sure that they're coming from a place of understanding what's going on and having risk management, and they have risk calculators, and they have a lot of things working for them that the average person doesn't do. And that's why, again, the average person will lose money. The professionals will make money in this game. So that's trading for you. Trading also has another kind of piece to it, which is futures trading. That's in simple terms, that is the same thing again, where instead of borrowing money from somebody, you're just betting that the prices are going to go up and down. In its fundamental nature, it's a little bit different. You're buying now and selling later, and selling now and buying later. But let's just simplify it and say, anytime somebody says I'm trading futures, they're effectively again making a bet that the price will be higher later or price will be lower later, and that's what they're doing. They're traders. Another way that you can stay in the market. Let me get comfy here. Okay, now that we're comfy. Another way that you can enter the market and participate in the market. So let's think about, when you're investing, you're putting your money ideally into safe assets, into assets that you know are going to be there tomorrow, that they're not just going to disappear, that they aren't scams, that they're going to make you money, that they're reliable, right? Another way of entering the markets is something called ICOs and IDOs. ICOs, initial coin offerings. IDOs, initial DEX offerings, which is initial decentralized platform offerings, basically. All it is there's new cryptocurrencies being launched all the time. And if you participate in their launch, sometimes before they launch or right after they launch, then you're getting them right when they are in their nascent stages, when they're in their infancy. So you're getting them for very, very cheap prices. Now, if it's a big project and has a lot of potential and it grows a lot beyond that, then you have a huge potential to make a lot of money there. But remember, whenever you have a huge potential to make a lot of money, you also have a big potential to lose a lot of money. Because if you remember from our previous podcast, a lot of cryptos are scams. Even beyond that, a lot of cryptos don't have the right teams behind them. Even if it's not a scam, they might not have the right team, so they can't execute on that plan that they've set out, and they can't kind of stand true to the promises that they're making you. So when you're doing ICOs, when you're investing in these new baby companies, there's a high likelihood that you could lose your money, because they may just, sometimes honestly, the people making these cryptos just take the money and run with it, because this is not a regulated market. They could just take your money and run away with it. They could not come true on their promises and fail, and now your money's lost. But on the flip side, there are a lot of projects that are really good bets. And they're really good at what they do. They have good teams. They have good fundamental use cases. And if you catch them while they're new, and they go to billions of dollars of valuation, then you can make a ton of money in that space. Again, not financial advice. I'm not saying you're going to make a ton of money, but there's a lot of potential to be able to multiply your wealth that way. So that's something that people do. Some people will invest in ICOs and IDOs, and that's how they enter and stay in the market. So, they would buy it before it launches, or buy it right when it launches, either ride it up to some point when the prices are high and sell it then, or sometimes people hold it long term. But it's getting in at that basic stage that is the IDO-ICO strategy. Now, one more that a lot of people don't think about, and that's actually becoming much more popular, is, we talked about you buy some crypto and then you sell it when the price is high, and now you have tax. Instead of doing that, there's others who actually buy cryptocurrencies and they hold them as assets. So they're having that long-term strategy that we talked about, long-term investment strategy. And when they need cash, when they need money, they actually collateralize their assets. So what that means is they take it to a bank, and they give the bank the cryptocurrency assets, and they say, let me borrow some of the value of this asset. So you still own the asset. You still own the cryptocurrency. You never sell it. You give it to a bank. The bank lets you borrow against the price of that asset. Now, if you know that every 4 years the prices spike and the prices go up, then hypothetically, and sometimes in real terms, that cryptocurrency will keep going up in value. So when you borrow some percentage of the value and you give them the crypto, over time that cryptocurrency becomes more and more valuable, so you can borrow a little bit more against it. And you're always borrowing a fraction of the growth of the cryptocurrency. So it's growing at a faster rate than you're borrowing. So you can actually keep getting cash and never have to sell your cryptocurrency. Now, another thing with that is debt is not taxable. So you don't pay tax on your cryptocurrency because you don't sell it. You've never had a taxable event. And then you also grow your assets because you're not selling them, you're holding them, and you're able to still get cash. Now, obviously, in that situation, you're taking on debt. So that is a risk that you're taking on, because if you give them a cryptocurrency, an asset, and let's say today the value is $1,000 and you borrow $100 against it, if the value of that asset goes below $100, they take it from you. So you're risking that asset. You're taking the risk that the value isn't going to drop down lower. So there is a risk there, but there are people who will borrow against their assets to buy more cryptocurrency and be able to multiply things that way. So that's another way of staying in this market. Again, because I've said this now, don't just go do all this stuff. Do your own research. Remember, that's always our motto. Do your own research and see what's good for you, what feels comfortable for you, what's something that you can resonate with, that can be a long-term strategy where you can actually, this is a good way for you to participate. Because when I'm working with clients, a lot of times I really have to do kind of a psychoanalysis. I have to do a psychoanalytical assessment to make sure we know what kind of lifestyle they have, what kind of lifestyle they would like to have. how much time they're willing to put into this. Is this just something that they want in the background, or is this something that they're going to have at the foreground of their mind? Is this something that they want to get really involved into, or is this something that they're averse to, and this is something that they'd rather not kind of spend their time working on? What kind of quality of life are they expecting from this experience, and how much can this kind of interfere with their existing quality of life? How technical are they? How much are they willing to learn, and how much kind of responsibility do they want to take in this whole process, or do they want to kind of automate it and have it as safe as possible? So all those things will determine which strategy you take, and how you play the markets, and how you enter, and how you stay in there. Because a technical person, like for me, I'm doing about 3 of these strategies. You know, I've split up my portfolio in a way so that I can actually do multiple, and I really like the fact that I have to learn about it, and you know, I've taken months and months to learn some of these pieces, taken years to learn some of these other pieces, but for me that's fun, so I really enjoy it. For the average person, you might want to pick one initially. You might just want to pick, you know, the investing route, which is what most people do because it's the simplest to understand. It's the lowest risk as far as making sure that, you know, you're not going to lose your money as long as you don't sell it. So you have to determine what you'd like to do and how you'd like to do it. Okay, great. So now let's, you know, if we're talking about how to stay in the markets, now you kind of understand these aren't all the ways, but these are kind of the biggest, the most well-known and used ways of staying in the market. So, okay, you've chosen one, you've developed that into your strategy, and you know, this is what I'm going to do, this is how long I'm going to do it for, and you enter the markets. Now you're in there, now you're sitting in the markets. You have to make sure that whichever strategy you choose, your risk management is going to be one of the most important pieces of it. So if you're investing, you have to make sure you spread out your risk. You are not completely invested in just one crypto. You maybe aren't just putting all of your money into some unknown cryptos and hoping that you make, you know, 1,000 times profit and you're shooting for the moon. That's not a very smart way of doing it. You also want to make sure that you're not just in one industry, that you spread it out across different industries and different use cases, because everything is not foreseeable. Something could happen which you're not predicting. So you want to make sure you spread out the risk by having uncorrelated industries where they're completely disparate, they're completely different, and the cryptocurrencies that you're using that service those industries have different use cases. You want to make sure that you have, you know, some really safe ones like Bitcoin, Ethereum, some kind of medium risk but also medium reward. Again, not financial advice, but this is just what the average person does, that a smart investor would make sure that they have some really safe ones, some that will give them more reward but are a little bit riskier, some that are a little bit down the risk curve. So like, you know, for me, staying in that top 100 is really healthy because they tend to be tried and tested projects. Some of them, actually a lot of them, might not be there in 4 years, but picking the ones that you really resonate with, that are in different industries, that have proven use cases, that's a great idea. And then if you want to, you know, take some small part of your portfolio, and in simple terms, when we say, you know, a small part of your portfolio, that literally means out of all the money that you invested, a small part of that money, and put it into the riskier ones where, you know, you're investing it into really small coins, and maybe if it goes, it makes you a lot of returns. But spread it out into different industries, different cryptos, different risk levels, and have a balance so you understand, okay, this is what I feel comfortable with. You know, some people like to take more risk because they're looking for higher levels of reward. Some people are not really comfy with that, and they would have a hard time sleeping. So you would want to go into something a little bit safer so you can get a good night's rest. Because let's be honest, it's all about a good night's rest. It's all about quality of life. For me personally, and you know, that's something that I always make sure that I resonate. That it's all about quality of life, and whatever does that for you, that's a good idea to do. Okay, so you figured out the risk. You're like, this is how much risk I'm taking. This is what I'm doing in the markets. I'm in. Another question I constantly get is, which exchange do I keep my crypto on? That's a good thing to think about. So if you're buying, which exchange you keep it on? And the answer for me is no one exchange. You ideally don't want to keep, all of your money in one bank, and you don't want to keep all of your eggs in one basket. If you're collecting eggs and you have baskets, you don't want to put all of your crypto just in one exchange, because that is also part of risk management, that you want to make sure that you have multiple exchanges. You have multiple places that you can put money on and take money off. The reason why is because anything could happen. The exchange could get hacked. You could get hacked, and then the person has access to all of your money from one exchange. And honestly, it's the person that usually gets hacked. It's less than the exchange. They'll hack you as a person, because you're much easier to hack than an exchange. But also, the exchange could have an outage. When you're trying to sell, and especially when these markets get really hot and there's a lot of kind of volume that's being put through, so a lot of transactions that are happening, exchanges have outages. The account could get blocked. There's many different things that could happen which lend themselves to you not having just one exchange. So have minimum 2, but I recommend 3 or more exchanges. That way you have multiple kind of redundancies to make sure you can get your money off and get your money on. Get your money on and get your money off. Get your money on and get your money off. Do the get your money on, get your money off dance. So, which exchange you keep it on? You have multiple exchanges. Now, I'm not saying just keep it on the exchanges. Even the storage part of it, there's a lot of different ways of doing that. Some people, they like to keep it on an exchange. They feel comfortable that the exchange is like their bank. They have safety measures in place to be able to store the stuff. And if you trust the exchange, you can keep it on an exchange, multiple exchanges. Some other kind of people in this market, they are here because they've kind of lost trust in the banking system. And the whole point of cryptocurrency is supposed to be that it's decentralized and there's no central authority that you need to trust and let hold your assets. So they'll actually hold it themselves. That's the beautiful thing about cryptocurrency, that you can literally hold it yourself. So what does that look like? You can move it and put it into your own wallet. So what that means is basically it's a computer program that you can put your own cryptocurrencies into effectively. So the way you access cryptocurrencies is through something called a private key. And that private key is tied to a public key, and the public key is where all of your assets are stored. I'm not going to go too deep into that, but the idea is that public key is tied to the wallet, and that public key is like the account number that you give out to people so they can transfer things to you. You can publicly give it out to people. The private key is the password effectively to get into that wallet. And that's what a wallet is. You could have this wallet on the cloud. You could have it on the internet. So some company somewhere is holding the wallet, and then you have the access to it. You could have it on a little USB key physically, so you can actually put the cryptos on there, and you need that USB key to be able to recover the crypto. You could put it onto a computer, you can put it onto a cell phone, you can put it onto any piece of technology. That's a way of storing it. Now, some people, what they do is they just take that private key that we're talking about, which is the ability, that's your password to be able to enter your wallet, and they just write it on a piece of paper and they hide that piece of paper. That's called a paper wallet. So effectively, anybody who has access to that piece of paper could access the money, anybody else couldn't. It's a beautiful thing in cryptocurrency. You can literally become your own bank with a piece of paper. Some really kind of even crazier people, I know, I'm just kidding. I love you, my crazy people. They actually will put their cryptocurrency onto a wallet, and that wallet will come with a 24-key passphrase, sometimes less, but a passphrase basically. It's a bunch of different words in sequence. And they'll memorize that sequence of words. And now, the only way you can access that money is by the stuff they have memorized. So they're storing all of that money in their brain effectively. it's amazing. It's literally the most secure way of doing it. Now, that person could forget those words, and this has happened a lot of times in this market, where somebody forgets the password and they don't have it backed up, and they have officially lost access to their own money. So this comes with a lot of risks as well, where, if your private key, if somebody finds that piece of paper with your private key, they can access your money. If you forget the password, you could lose access to your money. If somebody gets access to your passphrase, that multi-word phrase, they could access your money. So everything comes with a risk and reward. But obviously the benefit is you're holding your money. Nobody can block you. No regulator can take it from you. You're not trusting a third party to hold your money. So that's another way of keeping it. A few other ways of kind of keeping that money is sometimes, especially with clients who have large amounts of funds, they actually keep it with custodians. This is the opposite of holding it yourself. This is where you give it to a trusted third party who is a certified custodian. And what they do is they put it in their vaults. They actually secure it, sometimes using military grade security. And often they'll come with insurance. So if you do have a lot of money, and obviously you don't want to just trust yourself to remember some password, you would then give it to these custodians. They charge you a small fee to be able to hold it for you, and they'll give you insurance coverage so that in case they lose your money, you have complete insurance to be able to recuperate the value of the assets. So that's kind of a completely opposite way of doing it. Now, if you're storing a lot of money, I definitely recommend it. Anything above $50,000, it's definitely good to keep it in a custodian's hands. But again, it really depends on your personal beliefs, how you're going into this. So I'm not going to say everybody should do it, but just that's something you have an option to be able to do. But now, if you think about it, if you are storing it in these kind of vaults and hardware wallets and other things, then it's going to take a few steps for you to sell it when you need to sell it. When you have it on an exchange, you want to sell it and you click a button and it sells. Because it's on an exchange, you just exchange it for another coin, or you exchange it for money, whatever you like. If you have it on all these other means, it may take some time, for you to transfer it from the hardware wallet, or transfer it out of the existing wallet to an exchange, or transfer it from a custodian to the exchange and be able to exchange it. So these things have to be thought about ahead of time and should be part of your strategy. But these options exist. Another way to kind of, this isn't really a way to keep your money, but a lot of people keep money like this, where they have it in the decentralized finance world, where they are staking it, or they're yield farming on it, or they've borrowed against it. So effectively, it's either put into a wallet that is doing something, or they've given it to a bank to be able to borrow against it. So effectively, it's being put to use already. So that's another kind of way that people store it. I'm not saying that's a storage method, but that is a way that people will store their money. So now, hopefully you understand, what you're doing in the market, what strategy you have as far as what activities you're going to be doing in the market, how much risk you're taking on, which industries you're in, how you spread out your portfolio to make sure it's risk balance. If you're keeping it on exchanges, which means you're storing it in. Now, the next kind of piece tends to be, when do I pull it? When do I actually sell it? It's all fun and games getting your money in there, but when do you sell it? Great question. So that's where your strategy has to, from the beginning, have some kind of profit-taking points. Because one of the biggest ways that people lose money in this market is they don't take profits. Either they take profits too early, that you put some money in and it goes up a little bit, and you don't give it time to actually grow to the potential that it would, and you take out your money too early, and then they watch the market go way beyond where they were, and they're like, I could have made more. That's one way. But the more common way is putting it in and not taking profits along the way, and then the market goes up, and then it drops off, and the prices get way cheaper, and then you're watching all of that money that you potentially could have made just basically disappear. So you have to have set profit-taking points set ahead of time. It's a really good idea to have a strategy that looks at the macroeconomic situation, looks at the projections for what is expected to happen in the market, when is expected to happen, so you can have an idea of when you want to take your profit. It also kind of ties into when you need the money by, how long are you investing for, what kind of risk tolerance do you have, how long, it literally depends on you personally, and according to that you would actually adjust profit taking points. Maybe you take it a little early, or maybe you take it a little late, depending on how you'd like to participate in the market. And of course you have to have a profit-taking strategy that goes all the way until you've taken all of your money out of the market, if that is what you're planning on doing. Like if you're one of these short-term investors who wants to ride the market up and take your money out at the top or close to the top, you have to make sure you set up profit-taking points ahead of time, because when these markets get hot and things are happening, it's hard to control your emotions. And at that point, usually people don't think about when to take out the money until it's in that heated, passionate state. So then you're really inclined to make the wrong decision and act from a place of emotion, which is exactly the opposite of what we want you to do. Acting from a place of emotion is one of the biggest ways that you lose money. Or sometimes people get greedy and they don't take out money, and that's another way that you will lose money. So set profit-taking points ahead of time in your strategy. Very important. Now, sometimes I get the question, so Sim, I've seen it pump up, I've seen it go up, and I put in X amount and now I have some profit. Should I take out that profit and put it into something else? Or maybe should I take out that profit because I'm seeing it go up and then it goes down, up and then it goes down. So should I take out the profit at the top and put it in when the price is down? Now, logically that makes sense, right? The price goes up, you sell a little bit, and the price goes down, then you buy a little bit. And as a beginner, it's really easy to fall into that trap of thinking, well, this seems simple. It keeps going up and down a couple of times. Next time I'll pull it out when it goes up, and then I'll put it in at the bottom. But this is also one of the things that lends itself to a lot of people making mistakes, because again, when you're doing it from a place of not understanding the markets, not understanding chart analysis, not understanding the fundamentals, then you're probably going to pull it out where you think is the top, and the market's going to move beyond where you thought was the top, and then you're going to have to buy in at a higher price. You could pull it out and the price could drop, and then you could buy it in at a lower price. Both of those things are possible, but the chance of you being successful in that is low if you don't know how to do it, right? So if you're a trader and this is what you do for a living and you're constantly watching the markets, great, do that. For the average person, just know statistically, the person who holds through the market and sells it at the right time makes more money than the person who's trying to trade back and forth. Because again, the average person does not have the skills necessary to really be able to time and predict these things. Whereas the market manipulation that's causing the price to go up and down is being done by professionals who understand that this is something that's going to be enticing to you, and they'll use that against you to cause you to take actions that'll make you lose money. So am I saying don't do it? No. If you know what you're doing, do it. If you want to learn how to do it, you can. But should the average person do it all the time? No. Just put it in there and follow your strategy. Again, you could do whatever you want. This isn't financial advice. I'm just a guy, just telling you stuff. So as far as, same thing kind of applies to, should I pull some out and put it into something else? That's a very known strategy. People do that. You put in your money. Once it grows up to a certain point, you take some out and you put it into something else, and then that grows and you take some out and you put it into something else. Very doable. Makes a lot of sense. If you know what you're doing, definitely do it. If you're a beginner and you don't even know what any of that means and how to be able to read markets and charts and predict which thing is going to go up and which thing is already low, then don't do it. Because if you don't understand it, don't do it. Just get in there and just hold. You'll make more than enough. Don't be greedy. Don't come from a place of like more, because that you are teaching yourself the wrong psychology, which will lend itself to you making mistakes later on, because again, that psychology will be used against you. Always remember, it's your psychology that's gonna cause you to make the wrong decisions and actually lose money. And oftentimes when these things seem simple, just think, if it was that simple, everybody would be doing it, right? I mean, what is simple is entering the market when it's low and getting out when it's higher. That is something simple enough to do. That's why you see so many people doing that, because you try to enter when it's somewhere close to the lower end, and then you try to exit when it goes higher. That's a pretty straightforward strategy that almost everybody can do. So that's what most people do. But this trading back and forth or reinvesting the profits, that's a little bit more complicated. So you have to make sure you know, you've learned, you understand what you're doing before you go and do it. Now, a few more pieces while you're in the market and how to stay in the market. One really important thing that gets missed a lot of times is analytics. That, you know, when you're making these transactions, when you're entering the market, when you're doing all these things, and even if you're moving things around, a lot of times people don't track what they're doing, right? So you don't even know how much you put in at the beginning. Yeah, right now it might be sitting at 10,000, but did you put in 1,000? Did you put in 2,000? Did you put in 5? Nobody's keeping track. So how do you know how much you've made? How do you make the right decisions as to when to take how much profit? All those kind of things. So it's really, really recommended that anytime you make any kind of transaction, record it. How much did I buy? What date did I buy it? What exchange did I buy it on? How much was the US price, USD price, or whichever currency you're looking at it? How much was the price in dollars or currency? How much of each coin did I buy? And if you can just record these things, it's a great way of making sure that later on, when you do need to go back and check, like, well, how much money have I made? How much should I pull out? How much of each coin do I have? And all that kind of stuff. It's a great way of making sure you have statistics for that point. And obviously, if you've done a proper strategy session, you will have the resources and tools necessary to do that. But let me just give you a bit of an overview. There are great tools, like there's CoinStats. It's a tool that allows you to be able to track your investments. There is a paid option for that one. There is a free option as well that will serve most of the needs necessary. Some people use Excel sheets, just an Excel sheet that tells you what you did, how much you bought, how much you sold, everything that I just mentioned. You record that on an Excel sheet. Simple, easy, doable. Another thing that I often recommend is that you can put it into an app like CoinMarketCap or CoinGecko. So you would go in there, go to your portfolio, add in whatever you've done, if you bought or sold, how much of each coin you have. Every time you do it, every time you make a transaction, you update it inside of your analytics app. And that way you have a live view of what's going on, how much you've bought and sold. You have a clear view of what your portfolio is at, all of your investments, how much they're worth, so you can understand how to take profits, when to take profits, all that. Now, this kind of leads us into the last piece that I want to talk about, because now you're your bank. You know, if you are investing your money, you are the investment advisor. You're the hedge fund. You're the bank. You are the end all be all when it comes to, you are the security. You're everything. So you have to make sure you're secure. That's an important piece of staying in these markets, is security, because if somebody gets access to your device, they have access to your money. Somebody gets access to your computer, they have access to your money. So, like I said, you are the easiest thing to hack in this whole sphere. The cryptocurrency is not the easiest thing. The exchange is not the easiest thing. The human is always the easiest thing to hack. So here's a few things that you can do to make sure that you're secure. You know, if you are tracking your portfolio and your assets on an app like we just discussed, let's say CoinMarketCap, then you don't need to open your exchange. Ideally, don't open your exchange all the time, because it's really tempting to open it and constantly check how much is in there, how much is in there. That really creates a security hole where somebody could compromise you. You know, if you're sitting on a public Wi-Fi and you have no VPN and you're just sitting there checking your exchange, that really lends itself to you being hacked somehow. I mean, it is hard, but it's not, depending on how much money you have sitting in there, you definitely don't want to take that risk. I mean, no matter how much money you have, don't take that risk. You know, keep your exchange closed, keep your portfolio tracked on an app on the side, so you can check how much you have without ever opening the exchange. You know, a bank doesn't open the vaults all the time to actually look inside to see how much money they have, right? They have like a computer system that tells them how much money they have. It's the same way. You're the bank vault now. Don't just open the bank vaults all the time. Only go into your exchange to buy or sell. Otherwise, just follow the analytics app. It'll tell you what it is. Great. That's a great way of being secure. obviously never share your logins, never share your passwords, never share that private key that we mentioned. Sometimes people get it confused between the public and private key, and they'll send the private key to somebody. Definitely don't do that. That's very specific thing to make sure you watch out for. Never share that long passphrase that we talked about. That gives you access. Never share that little piece of paper, obviously. But also, when you're activating accounts and you're getting two-factor authentication activated on any of these, which obviously that's another piece of security. Make sure you always have 2 to 3-factor authentication activated on every exchange. What that means is when you enter your password to enter an exchange, they'll ask you for other codes, a Google Authenticator code or text message or email code or something, where just the password won't get you into the account. You have to enter these other things. That's two-factor authentication if you have 2 things, or 3-factor or more factor. But when you do that, a lot of exchanges allow you to set up Google Authenticator accounts. It's a 2-factor authentication app that allows you to enter a code. They'll give you a key, Google Authenticator key, that you use to be able to activate that app on whichever device you're using. Save that key. Make sure you save that key somewhere safe, because if you lose your phone or something happens, you will need that key to be able to activate the Google Authenticator app, and you might not be able to access your account without that. So make sure you save that. Great security tip. One of the final and the biggest piece that I'm going to tell you about staying safe with crypto is don't go around telling people you have crypto. Don't scream it from the rooftops. Don't post it all over your social media, and don't run around, jumping for joy every time you make money and telling people, hey, I just made this much money. That's a great way of becoming a target for people so that they can actually try to get that money from you, right? So obviously be very careful about who you share your portfolio with and who you share the knowledge with that you actually have some crypto, right? So that's just a fundamental fact. Like, the richest people in the world don't run around screaming, hey, I have billions of dollars, come and take it from me, right? Good way of staying safe. So that kind of gives you a general overview of how to enter, how to decide what you're going to do in this market, how to make sure you manage risk in this market, how to take some profits, have a strategy around that, how to stay secure, how to store your cryptocurrencies, and just in general how to participate in this market intelligently. So hopefully I've given you a lot of value and a lot of knowledge as to what kind of stuff you can do and what pitfalls you don't want to have. And in the next piece, we'll be discussing how to make an exit out of this thing. So thank you so much for listening. I really appreciate you as always. I'll see you next time. Till then, sayonara. See ya.